Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look through the disclaimer, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So in this week's webinar, we'll first look at global risk sentiment and the idea of risk on, risk off. And we'll also do a deeper dive into safe haven currencies. We'll then also check out the S&P 500, probably the most well-known global risk indicator. After that, we'll preview what's on the calendar in the next few days, and then we'll check out some of the major currency pairs, both on the fundamental side and also on the technical side. So we'll be looking at the technical analysis as we did last week, looking at both sides. So firstly, just to wrap on last week, or last time actually, a couple of weeks ago, we highlighted dollar strength, and we highlighted the unprecedented really scale of interest rate hikes that were being priced into the Fed tightening cycle. Quite unprecedented. Some of the hikes that have been priced in, not seen since the early 80s. And since then, obviously, things have changed slightly, especially with regards to the dollar. And we could see on the chart here, the weekly DXY chart, the dollar was obviously sold off most recently. So it had its worst week since early February, and it dropped for the first time in 7 weeks. And last time out, we did question then whether the dollar could benefit from the yield story, so from the interest rate differential story that the dollar had been supported by, and we had the US 10-year Treasury going above 3%, and this contrasted with the deterioration and growth forecast being cut elsewhere in the globe. Since then, of course, and more recently then, this Fed tightening narrative is now really largely factored into markets, and a lot of the good news is in the dollar. And just one caveat to that, for example, the 75 basis point hike that potentially people were talking about a few weeks ago, that certainly is now an idea that is waning. And even then, we've had much less talk about the 3% terminal rate for the Fed funds rate. I think, interestingly, I think positioning at the moment is quite important. So that's with speculators, with big players in the FX markets, because the market is in the process of rebalancing heavily skewed long dollar positions. So a question in the short term will be the unwinding that we've seen over the last 10 days or so. How much more do we have of that position squaring? I think one of the other reasons that we gave a couple of weeks ago for the bid in the dollar was that safe haven bid. So geopolitical risk and the risk off sentiment meant that the dollar was in demand, and we mentioned that there is that inverse correlation with global growth, with the risk sentiment, with the dollar. And we know that yes, when the mood darkens, if you like, the risk mood darkens, then investors go towards the dollar and seek haven in that. And I just wanted to really sort of go into this idea, this concept of risk on, risk off, and really see, just a deeper dive into this idea, and also then safe haven currencies. And you can see on the slide here I put together, we've got this risk on side on the left and then the risk off side on the right hand side. So what do we mean by safe haven currencies, first of all? So these are currencies expected to hold on to or increase in value in times of uncertainty, in times of geopolitical or market stress, so general market turbulence. And there are three main safe haven currencies. Those are the US dollar, the Japanese yen, and the Swiss franc. Why are these defined as safe haven currencies? Well, the principal reason is because these countries should own a large amount of foreign currency assets, meaning they may sell those foreign assets and bring back home when volatility increases and risky markets are weak. And in a way, it's self-fulfilling, this, where currencies tend to respond automatically to uncertainty. So this leads to traders and investors knowing that certain currencies will appreciate, that have appreciated in the past, in fact, during times of risk off, or traders will buy those currencies in anticipation that they will react in the same way as they have done historically. So just a look at the three currencies. For the dollar, we've mentioned before, it's the bedrock of the global economy. Of course, it's the world's reserve currency, with around 60% of foreign bank reserves denominated in US dollars. It's, America is the safe store of international capital, given the size, the huge size of the US economy and of their financial markets. And also, if you think about it as well, investors in times of stress, in times of market turbulence, will buy US treasuries, will buy US government bonds, which they see as a safe haven. And in order to buy those, they need dollars, and that will push the price of the US dollar up. For the Swiss franc, that safe haven status has really been earned on merit. So you think of the stability of the Swiss economy, you think of the strength of its financial system and political stability in Switzerland in general, and then there's a high confidence in its central bank. And those factors really have shored up the Swiss reputation as a store of value. So again, if the Swiss franc is appreciating, going up in value versus high yielding currencies, then there's probably some market turmoil somewhere in the globe, and currencies will flee to the perceived safety of the Swiss franc. And such price action from that franc would indicate a risk-off environment. Finally, the yen. Well, in many ways, it doesn't have, it has no right to be a haven currency in many ways. We know that Japan's economy has been weak, and it's well known as having vast debt, quite alarming demographics, and it's prone to deflation. So there are other complex reasons as to why, but principally they're related to the Japan status as a large exporter nation, which has given it a currency account surplus with the rest of the world. So what does that mean? It's the world's largest creditor nation. So Japanese investors hold more foreign assets than foreign investors own Japanese assets. So in times of stress, again, as we've mentioned, Japanese investors will then sell those assets and the capital is repatriated back to Japan, pushing up the currency. We should also probably mention regarding Japan, the beneficiary of the carry trade. You might have heard that phrase used a lot in the last few years, especially. So the carry trade, that means when investors borrow money in low interest rate currencies and then invest in a higher interest rate currency, so benefiting from the gap between the two. And even in this low interest world that we have been experiencing over the last few years, Japan's long-term policy of zero interest rates really stands out and still does in some ways. So yeah, we think it's really good to just recap on what risk on, risk off sentiment is. It's that change in behavior, change in activity in response to global economic patterns and in response to global economic sentiment. So investors become more risk averse. And on the right hand side, you can see the big red arrow down. Risk averse means selling equities, selling high yielding growth cyclical currencies like the Aussie dollar, like the Kiwi dollar, and then buying US treasuries, as I've said, buying bonds, buying fixed income instruments, which investors will flock to when times are uncertain. Obviously, on the flip side, then on the left-hand side, when times are better, the sentiment is more optimistic about the economy, about geopolitics, then investors will dive into riskier assets, stocks, high-yielding investments, all dependent on strong economic growth. And then we'll see those commodity-based currencies, again, the Kiwi, the Loonie, the Aussie, benefiting from that. As I say, really worth thinking about that concept as we come into these times that we are at the moment, volatile times. It's easy to take this for granted in some ways, but crucially, we think volatility is certainly here to stay. Investors are really trying to get their heads around or really get a grip on what is exactly going on in markets at the moment, and it's really this battle, this push-pull, if you like, between inflation, between growth, and between potential recession or at least a slowdown in growth. So by looking at risk on, risk off, treating the markets as such, then we can really decide which currencies to buy, of course, which crosses to look at, which currency pairs to trade. As I said, one of the biggest global risk sentiment indicators is the benchmark US equity index, the S&P 500. So I pulled up a chart here, the weekly chart. And risky assets, stocks especially, are desperately trying to stabilize at the moment. And we could see, well, the S&P's had 7 weeks of consecutive losses here from that high in sort of late March, 7 weeks. That hasn't been seen, 7 weekly straight drops. We haven't seen that since 2001. For global stocks, I think it's 6 weeks or so of straight losses, consecutive losses, and that's the longest losing streak since mid-2008. Just touching on that, obviously, we have had the issues around, just generally the Fed's efforts to fight inflation have brought higher interest rates, and that's put pressure on stocks pretty much since the start of the year. As I mentioned, we've seen the yield on the widely watched 10-year US Treasury. That's nearly doubled since the start of 2022. And that really has hit the appeal of riskier assets, especially tech and growth stocks, where investors get less return at present by holding companies that might give higher returns in the distant future. That's a sort of general overview since the start of the year. And then, especially more recently, the market has focused on quite downbeat earnings, and we got those especially last week from 2 US consumer bellwethers, so Target and Walmart, and also yesterday then we had a reminder of that in Snap, and they've all generally issued really grim outlooks, and I think yesterday especially the start warning of this kind of macro deterioration from Snap, who just a month ago, after issuing their quarterly guidance, really gave a downbeat assessment and pressed all those sort of leading indicators, if you like, the leading indicator buttons, which are highly relevant at the moment. So you think of higher inflation, tick higher, and rising interest rates, tick supply chain issues, and the Russia-Ukraine conflict. So all those issues were brought up by Snap, obviously a social media tech company, which were then really brought to the market's attention, especially by those huge US retailers, Walmart and Target, last week. I think also we've had softer data, especially more recently, even yesterday, yesterday, we had existing home sales, which were much weaker than consensus thought, and that is the first sign really of how higher interest rates are starting to potentially impact the US economy. Technically then we can see on the chart the S&P narrowly avoided falling into a bear market. That was sort of headline news last week that we just conveniently just failed to drop into the technical definition of the bear market. That is when an index loses 20% from its recent highs. And we did actually manage to drop into it intraday, but then buyers stepped in on Friday and we pushed above the 20% marker I've shown on the chart there, and the S&P level is 3854. I think last Friday we dipped into 3810. So we did pull back, so we're not in bear market territory just yet. I think if we switch to the daily, yeah, so technically we can see that sharp downturn from late March, the late March high above 4,600. We had small consolidation in late April and early May around 4,200, and that really tallied with the late February low, which I've marked on here as being pretty much strong support around 41.14. Obviously then we've moved lower through that level, through the psychological level of 4,000 as well. And then I've put on, if we just switch back to the weekly, I've put on some fib levels here, so some Fibonacci retracement levels. I've marked this year's high at 4818, and then the pandemic low of 2191. And you can see that, yes, so last Friday we touched that 38.2 retracement level around 3815, so that acts as serious support now for a move lower. Below that then we have the the halfway point of that move, so halfway point between the highs and the pandemic low around 3505. So I know a lot of commentators, market commentators, are speculating that we go towards that level, a key psychological level for markets, potentially if we drop through that 3815 marker. Upside, of course, potentially we get bear market rallies. We'd have to get through that short-term resistance trend line there around 4,000, and then above there we might get back into some range trading because we'd have to push on, we think, above that 4114 level to really slow this downtrend and really get out of this bearish mentality. I think also interesting, just briefly I'll touch on a monthly investor survey which is done by the Bank of America, big US investment bank. They survey hundreds of fund managers, hundreds of hedge fund managers about their outlook on markets, on the economy. The latest survey came out last week, and those fund managers pretty much had the highest allocations in cash. So that's really the ultimate hiding place from trouble, if you like. They had the highest allocations to cash since 9/11. And also a takeaway we thought was the biggest negative view on big tech stocks since August 2006. So that's even beyond what was seen in the GFC and also beyond what we saw in the pandemic. I think now is a good time to look at the calendar. If I just switch now to the what we looked at last week, which was the CME Fed Watch Tool, appropriate because upcoming on the calendar tonight we have the FOMC minutes, and then Friday also we have the personal income and spending report from the US. But firstly on the minutes, we're likely to see a hawkish Fed, a relatively hawkish Fed, a committee set on interest rate hikes of 50 basis points at the upcoming June and July meetings. And if you remember from 2 weeks ago, we focused on this CME Fed Watch Tool. Really good tool to gauge what the market is thinking about future rate hikes by the Fed, done by meeting. So we can see the 15th of June meeting cast on a dead set for a 50 basis point rise, and also in July, yeah, again above 90% for another 50 basis point rise. But then interestingly now, the move for another big hike really is backed off. And I think I looked at this only yesterday, I look at this a lot, but yesterday it was pretty much a coin toss between a 25 basis point rate move and a 50 basis point rate move. And now you can see the market adjusting again, a bigger chance really, 2/3 to a third there of just a 25 basis point move against that bigger 50 basis point move. So always interesting to look at this CME Fed watch tool just to gauge what the market is thinking. And that has obviously given support to the dollar, which is now waning. For the minutes, just going back to those, so expectations really are for, as we've seen then from September post-summer, really to assess, the market is thinking the FOMC will assess the inflation outlook amid potentially slowing, or at least giving us an awareness of slowing inflation and slowing growth. So after summer really is key to what happens. We're probably some of the most clearly communicated rate hikes in modern history, really, with those 250 basis point hikes. But after that is what is key for markets and for the dollar especially. And we've had recent Fed speak, Fed President Bostic, I think, implying a pause potentially may be possible. We also get on Friday the personal income and spending data out of the US. That data, well, that's expected to show solid real spending growth, but again, we should be wary of purchasing power, which is an ongoing concern. We also get the core PC deflator. So that's the Fed's favored inflation gauge for monitoring price rises, for monitoring inflation. That's expected to fall to 0.2% from 0.9%, and year on year from 5.2 to 4.9. So it potentially looks to have crested, as we say, and the slowing inflation theme is gathering steam, if you like. Just to touch on the core PCE, obviously a lot of people follow the US CPI figure as the main event, but the core PCE is what the Fed likes. It's used this, it's relied on this gauge since around 2012, I believe, and chiefly because it takes into account, as I'm sure some of you know, goods and services bought by all US households and businesses. So in contrast to CPI, that only calculates spending of Americans living in urban areas, as opposed to those living outside of major cities. And also the PCE, that includes a broader and more comprehensive range of purchases in its calculations. And we think key going forward will be, in this bunch of data generally, will be how households are prepared potentially to run down those savings that they accumulated through the pandemic. And we've seen that in some of those earnings reports that we said, the grim outlook for Target and Walmart especially. So potentially we might see that in Friday's report. I think now is probably a good time to look at some of the majors. So we'll look firstly at euro dollar. I think a good chart to pull up is one that I've just generated off Bloomberg, which you can see here. So that's just showing where bank rates, where the base rate has moved since 2010. So you see the white line is the Fed, the increase up to 2.5%, then obviously back down. And then the Bank of England in the dark blue and the ECB in the purple, in negative territory since 2013, 2014, and currently at negative 0.5% rates are. So interesting to see just the contrast then. And then also, I think what is key, if we just pull up the chart, actually what I'll do is also pull up a different chart that we haven't used before, but I think we'll just briefly touch on, which is the spread between interest rates. And I don't want to get too complex here, but we can see, so this chart just shows us the difference between European two-year rate, two-year yield, so the German two-year yield, the Schatz, and the US Treasury yield, the two-year Treasury yield. And we can just see a lot of chatter in Wall Street, on trading desks, in the City of London especially as well, just about this base being built between that difference in the spread that you can see, and then we're just pushing off that those lows. So the lows being the widest spread, the point where that spread has been, and so this has obviously given a lift to the euro, and obviously showed us that stuttering growth in the US is potentially being shown on that chart. Don't want to get too technical with that, but we think it's worth highlighting. The euro dollar chart here that we can see, I just want to touch on the fundamentals, because there's been a lot of noise, a lot of excitement really, by some of us who follow central bankers, who follow their rhetoric and who follow their speech. And just yesterday we had really quite a gear shift from the ECB president, Christine Lagarde, in a blog post she posted on the ECB website over the weekend. She was really quite relatively hawkish for her. Essentially she expects QE, so the asset purchase program, to end very early in the third quarter, and then this would allow for a rate hike to take place in July, in line with forward guidance. She also went on to say that the ECB are hoping to exit this era of negative interest rates by the end of Q3, and that implies then potentially a July hike and also a September hike as well. And this is really quite interesting. It's mid-meeting. It's ahead of the ECB meeting on June the 4th, ahead of the ECB staff projections, and also some inflation data, which we get next week, I think. So for the ECB president to write this kind of or show us this change in gear is, we think, really important. And obviously markets have reacted again to this. It's interesting that it kind of goes against a central bank who, as Lagarde has said, never, in inverted commas we say, never pre-commits. And there we are, she's signaling a rate hike in July and September potentially. But obviously markets welcome this visibility. They welcome the potential for then knowledge that there will be short-term, or in the near term, sorry, there will be hikes, a couple of hikes potentially, and then we would probably get some more flexibility built in, where we're data dependent on the path to this neutral rate, wherever that is. So really key driver for the euro here. I think last week's ECB minutes, that really confirmed this hawkish tone of most members, and they really seem to be keen to join the central bank bandwagon finally of monetary policy normalization. I know there are obviously hints, or some more hawkish members are wanting a bigger move, even a 50 basis point move, and no doubt the market will potentially push or price in that direction. There are around 30 basis points, I think, in the July meeting, and around, well, over 4 interest rate hikes by the ECB by year end. So it'll be interesting to see whether the market, as I say, pushes more towards that end, like we did in the US a few months ago, or essentially as the ECB moves away from this near zero interest rate policy. I think it's important to mention we do have a raft of ECB speakers today even. So we have the chief economist Lane speaking, and then again we have Lagarde speaking at Davos, I think. So I think that's the third time we will have heard from her this week, including that blog post. Probably really giving us a signal of what the ECB, or where the ECB is heading. On the technical side of things, I think, well, we highlighted this long-term bear channel, this series of lower lows, lower highs, back from the May highs, really, where we dropped down. But obviously then, well, we dropped down to a major support level of January 2017 low at 103.41, which I put on here. We got down to 103.48, I think, last week. Interestingly, we highlighted before that oversold RSI, but then also this bullish divergence in the RSI. So if I just show you actually on the daily, it's better. So we printed a new low in price, but we didn't print a low in that indicator, in the RSI indicator. So bullish divergence there, and we pushed off that major support level around 103.41 up into the 105 level. A little bit of intraday or intraday volatility and volatility late last week. And then another push again through that trend line resistance that you can see I've drawn on there from the March high, and then above, I think this was key, above 106.36, which was the pandemic March 2020 low. So we've pushed above there. That will now act as support. So 106.36 is now support, key support, with bulls obviously hoping to get towards the 108 level, which again will be a key zone of resistance now. Just ahead of there, you can see the blue line, 107.60. That's the 50-day moving average. So a lot happening in the euro. A bit of a sell-off today, potentially in expectation of those slightly hawkish FOMC minutes. Moving on to cable. So sterling versus the dollar, again, a lot been happening. Again, an oversold currency. Sterling had been hammered 7 consecutive days. I think if you remember at the end of April, and then again another sell-off. Fundamentally, a lot's been happening as well. We had a lot of data last week. That sort of mid-month UK data dump. If you think of, always think of the middle of the month, you always will get UK employment data on the Tuesday, you'll get UK CPI on the Wednesday, and then UK retail sales on the Friday. Those we pretty much had a mixed bag actually. So obviously we had the 9% CPI print, and we had retail sales coming in slightly better than expected. We then had consumer confidence, which was actually at record lows, and then mixed in. We also had some Bank of England speak, and I think that's worth noting. The chief economist was relatively hawkish last week. Last Friday, he had a speech, and he implied that the majority of the MPC, so the Monetary Policy Committee at the Bank of England, were leaning towards a more hawkish interpretation of its recent guidance. I think we think this is quite important because the economist Hugh Pearl has been in the middle ground really of the MPC, and actually not so long ago he had indicated that relatively limited further tightening was needed. So interesting comments from him. But as I say, a mixed bag, because then this week we've had UK PMI figures, and they've really signalled that, well, that the services manufacturing experienced a sharp economic slowdown in May. The figure I think was around 51.8 from above 58 in April. And that's the lowest since COVID lockdowns of February 2021. And if you think that 50 is the key line here in PMI surveys, so below 50 means we're in contractionary territory. And essentially this roughly is indicative of GDP, so growth expanding at a quarterly rate. I think economists are putting it at just 0.1%. So potential growth issues here, but also then we've had UK inflation in that picture is deteriorating. further. So I think it's companies' input cost inflation, so another marker for rising prices that hit another all-time high in May. So for the UK, on the fundamental side, the risk of a recession, of a sharp slowdown, even a technical slowdown, are growing as the economy really comes to a crawl really in May, while inflationary pressures are hitting new highs. And the PMIs do suggest that further Bank of England rate hikes potentially will tip the economy into a downturn, if not that recession. Technically, we can see cable, so sterling dollar, has really, yes, bounced similar to the euro. And on the daily, again, you can see that positive divergence. So a new low in price, but not in the RSI indicator. And then we've bounced through and cut through, broken above that short-term trendline resistance back into 124. And then bulls were obviously heading towards targeting 126.38, that level. And after those PMIs, you saw the sell-off yesterday, and then today we've seen a bit of dollar strength coming in. Potentially, we just trade in this sort of range, 122 to sort of 126, with that low at 121.55. The Friday the 13th low actually being a key level of support. Next major, I think sorry, I didn't ask if you do have any questions, of course, please do write them in the box if you want to talk about the couple of majors we covered, or some other currency majors or another market, then please do ask questions. And I'll answer them as we go along, or of course at the end of the webinar. I also meant to say just briefly, it'd be great to know where you're joining from. So if you could write that in the box below, that would be much appreciated. Just checking out another currency, I think we should probably look at the Kiwi dollar. Kind of relates to our risk on, risk off theme, and also obviously the RBNZ met overnight. Here's the Kiwi dollar chart. So yeah, the RBNZ, they hiked the OCR, so the official cash rate, by 50 basis points to 2% as expected. That was actually the 5th rate hike in a row from the RBNZ. But the hawkish surprise really was that the bank signaled a more aggressive front loading of future rate moves. So the peak OCR, the peak official cash rate now is potentially reaching 3.75, 3.75% in the first quarter of 2023, and that's much bigger than previously thought. For this year, they've raised the central bank, the RBNZ, have raised their rate projections to 3.25 to 3.5% by year end, and that's up by 1% from 2.25 to 2.5% from their February projections. So that was the hawkish surprise, really. But policymakers, we have to say, they did really highlight the hugely uncertain global economic environment that we're currently in, even as obviously these broad-based inflationary pressures and also the tight labour market is warranting faster tightening. The Kiwi dollar, just looking at the chart, well, obviously, as we've mentioned, the Kiwi is a risk-on currency, so that has definitely been hammered really in the last month or so from that high at the start of April at 70.41. Interestingly, anybody who's looking at the Aussie dollar chart, similar, of course, risk-on currency, and also that start of April, that candlestick there, which we highlighted before, which really is a bearish reversal candlestick. So it's a shooting star, similar to the Aussie chart, as I say. So that's a trend reversal candlestick. So a long upper shadow there, and then little or no shadow below, and then a small real body near the day's lows. so a very tiny small real body, and that sort of signaled a downturn to come. Downtrend was in play potentially, and we've seen that. Obviously prices in this very sharp downtrend down towards that low in mid-May, so a few weeks ago at 62.16. I've drawn on some fib levels just from that bottom up to that April high. The 23.6 Fibonacci level is at 64.10 that you can see, and that sort of tallies with that near-term trend line support resistance that we broke. And then above here we have major resistance at the well, the January low at 65.29. I think a lot will depend, of course, for the Kiwi, even with this front loading of the hikes, which should support the Kiwi for the next few months at least. But the generalized global slowdown will have an impact, especially against the dollar, and mean that the RBNZ, potentially those forecasts may be too high. But we can obviously see, and we'll recap on those as we go forward in the months ahead. Okay, I think we'll wrap it up there. But as I say, if you have any questions, more than happy to answer them, or answer them after we finish. I hope you've enjoyed this webinar. We've covered obviously the risk on, risk off ideas, safe haven currencies, looked at the S&P 500 as that global risk sentiment indicator, which is a key driver for FX markets as well at the moment. Thank you for registering and attending and listening, and please do sign up for the next webinar, which is on the 8th of June. All the best, and good luck trading out there.